Hi, my name is Jason. I'm one of the analysts here at Osborne Partners. Today, I'm going to review the real estate asset class, first reviewing 2022, then turning to our outlook for 2023. Driven by higher interest rates, 2022 was one of the worst years for real estate since 2008. U.S. REITs, foreign REITs, and home builders all experienced losses of 25 to 30%. Looking at the bottom half of this chart, we can see the dramatic increase in rates during the year. The 10-year yield increased from 1.5% to nearly 3.9%, while the 5-year yield increased from 1.25% to 4% by year end. These increases put downward pressure on the real estate asset class. Turning to the housing market, rate increases also had a significant impact on home prices during 2022. As you can see from this chart, by year end, home price appreciation decelerated meaningfully from the double-digit gains of 2021 and early 2022. National prices finished out the year with only single-digit increases, while home prices in the San Francisco Bay Area have turned negative on a year-over-year basis. While prices are trending down as interest rates have increased, we do not believe we are about to repeat the housing crisis of 2008 and 2009. Turning to our outlook for 2023, the theme of our outlook is that the market is rebalancing and not in a period of crisis. The housing market has begun to show signs of rebounding activity and improved sentiment, indicating the housing market may be bottoming. The top chart here shows the monthly supply of existing homes. As you can see, at 2.9 months, it's below the long-term average of 5 to 6 months, which is indicative of a tighter housing market and supportive for prices. Next, the middle chart shows the annualized sales rates for both existing and new homes. On the one hand, new home sales are at their long-term averages, while on the other, existing home sales are near record lows as the market is coming to terms with higher interest rates. The bottom chart shows that home builder sentiment has begun to rebound after bottoming in late 2022. This is in stark contrast to the period before and after the global financial crisis, where home builder sentiment was negative for several years. Turning to the mortgage market. The mortgage market is in a significantly better position today than it was in the lead up to the global financial crisis. These charts show the weekly new mortgage and refinancing applications on the top and the percentage of applications which were for adjustable rate mortgages on the bottom. On the left side, we can see that in the lead up to the housing crisis, mortgage applications were at record highs, and importantly, over 1/3 of new mortgages were riskier adjustable rate mortgages. Looking on the right side, we can see that mortgage activity picked up in 2020 and 2021 as borrowers locked in record low mortgage rates and the percentage of ARM mortgages hit record lows. Currently, applications and the percentage of ARM mortgages are near long-term averages. The key takeaway here is that today, there are not a significant number of borrowers with risky mortgages like there was during the housing crisis. If anything, borrowers are locked into low fixed-rate mortgages, which may discourage them from moving. This next slide shows the spread between the 30-year fixed-rate mortgage and 10-year treasuries. Historically, this spread has been about 1.8%, meaning that a 30-year mortgage rate has a higher yield than treasuries. However, in 2022, this spread reached record highs as interest rates increased. Looking forward, we expect this spread to narrow towards long-term average as the interest rate market stabilizes. The key takeaway is that we believe we have seen the peak mortgage rates for this cycle, and that rates can continue to decline even if the 10-year yield increases modestly. Now turning our attention to REITs. The various valuation measures for REITs are giving contradictory signals. On this slide is another spread chart that shows the difference in yield on US REITs versus 10-year treasuries. Historically, REITs have yielded about 1.4% more than treasuries. However, today this spread is about zero. The key implication is that investors who allocated to REITs primarily for income may rotate out of the asset class and into lower risk fixed income investments, putting additional downward pressure on REIT prices. Looking at REIT multiples, though, the implication is that REITs are trading at a fair valuation. This chart shows the price to funds from operations for US and foreign REITs, showing that both asset classes are trading near their long-term average, which is indicating fair valuations. Note that in early 2022, we trimmed our allocation to REITs when valuations were much higher. Now, this is an important table that shows the historical return of US REITs and the S&P 500 during periods of flat to declining interest rates. Since 1996, U.S. REITs have returned nearly double the S&P 500 during these periods. We believe this will be a powerful dynamic once interest rates eventually begin to decline. The key to our 2023 real estate outlook is that we believe the market is in a period of rebalancing and not a crisis. We expect that as the rate of interest rate increases slows and the rates eventually peak, that real estate will outperform. Already, we are seeing increasing activity in the housing market and improving sentiment. Within REITs, valuations are not demanding, and historical precedent indicates that flat to declining interest rates will likely lead to a period of outperformance. If you have any questions about our real estate outlook or the outlook for any of our other asset classes, please do not hesitate to contact your wealth counselor for more information. Thank you for listening.